Hey everyone, and welcome back to my channel. Today I want to talk about, kind of switch gears from looking at specific cities and communities in Arizona and talk about being ready to buy. For a lot of buyers, this is a really great market. There's a lot of inventory and rates are not what they were like, say, in the 1980s, which everyone loves to remember. But they're certainly not going to go back to what we had in 2020 to, say, 2022. So they're not outrageous, but they might not be exactly where we want to. So if you're thinking about buying a home, I want you to pause for a moment. Before you start scrolling listings, touring open houses, let's talk about what it really means to be ready, both financially, emotionally, and in a very practical sense as well. So before we get into what we'll call Buyer Readiness 101, I want you to hit that subscribe button and let me know in the comments if you have any questions about the buying process. Okay, so buying a home isn't just about affording your monthly payment. Obviously, that's very important. If you can't make your monthly payment, then you shouldn't, buy that house. It's about being financially prepared for the whole journey. Credit score. Most lenders want to see a score of 620 or higher. Better scores equals better rates. Savings. You'll need money for the down payment, closing costs, inspections, moving expenses, and don't forget to have an emergency fund because home ownership obviously comes with surprises and things that we're not planning on. Debt to income ratio. This is how much your income goes towards debt. And lenders typically want it below about 43%. So if you're juggling car payments, student loans, credit cards, it's worth reviewing your budget before you jump in. So I mentioned credit score. So this is, in a lot of ways, this is like your first impression financially to a lender or to someone you may be looking to for a loan. So think of your credit score as your financial reputation. Most lenders want to see 620 or higher, but a 740 or above unlocks probably the best rates. A higher score could save you tens of thousands over the life of your loan. And a tip, so you check your score early, dispute any errors, and avoid opening new credit lines before applying. So, if you're going to apply for a loan, but you need to buy a new car, you're going to have to balance which of those things comes first. And I'm going to also tell you is that after you've applied for a loan, to be very, very careful, if not avoid it 100%, opening up new lines of credit because that will impact it. So your credit score doesn't just get you approved, it decides how much you'll pay. So protect it like it's like your paycheck. Savings. So it's more than that down payment. Down payment is typically between 3 and 20% depending on your loan type. And I know, and I'm not even talking about like a VA loan, but when we talk about down payments, everyone says, well, it's 10 to 20%, 10 to 20%. It doesn't have to be. And there's a lot of loan options out there that will take 3%, 3 to 5%. So do not just listen to the media. Well, I was going to say don't listen to your parents, but that sounds like a bad idea. Listen to your parents. But don't just take some person advice off of the street. Talk to a professional and have that conversation with them about it. Closing costs, something you need to be prepared for. Usually 2 to 5% of the purchase price. So you got to think title fees, lender fees, taxes, buyer agent compensation. This has been a huge conversation in the news. As listing agents, we would talk about the buyer's agent and the listing agent compensation together at our listing appointments. Now it's completely separate conversations because what the seller is committing to a lot of times is the listing agent's compensation. They need to know that the buyer's agent is probably going to ask for their compensation to be part of the offer. And that's a conversation you need to have with that agent. But it's no longer the listing agent dictating and deciding what your compensation is going to be as a buyer's agent. Is now you as a buyer's agent with the buyer, or I should talk to you as buyer. So it's you as the buyer talking to your agent about what they charge for representation and how they're going to get that. Is that going to be through you? It's going to be included in your loan, or is it going to be us asking the seller for that compensation? But it is part of the costs, and we're not always great. Agents aren't always great about talking about how we get paid, but it has to be a real conversation to have. And I haven't really talked about the changes in how we do business in that way. I usually do that through a one-on-one conversation, but happy to talk about it. Okay, let me go back to costs and making sure you have savings before you get into that house or you make an offer. Inspections and appraisals. So you have to budget $500 to $1,000 depending on that property type. Your appraisal, your lender orders that appraisal. Sometimes your lender may say, hey, we don't need an appraisal done on this property for the type of lending that you're getting. So it's up to you. Do you still want an appraisal? And you can certainly still have one done. Again, though, either way, it's negotiated. It can be negotiated into the contract, but typically the buyer pays for the appraisal and the lender is the one who orders it. Inspection, when you work with an agent, ask them for a couple different inspectors, maybe not just say, give me one, maybe get a couple, and for you to evaluate and determine which of those inspectors is somebody you want to work with and what are they going to do, what's their reputation, and how much do they charge? And for that charge, what do you get? So that's good to think about because you're also going to, if you got a pool, you're going to want to have the pool inspected. Obviously, you always want to have the roof inspected. Gosh, I'm going off on a tangent here. If you're moving into an older home and in a very established neighborhood, I would consider a sewer inspection because a sewer line rupture is big money. Moving costs, truck rentals, deposits, furniture, it all adds up quickly. Do you need a storage unit, or is there going to be a time where, say, you leave the place you are, but you have a couple days before you can get in, before you close on the property? Or are you going to do simultaneous closes where they close on the same day? All of that needs to be discussed and thought about, and you need to plan for it. So if you need to be out on the 5th and you close on where you live right now, you need to be out on the 5th and you close on your new house on the 7th, where are you going to live in that meantime? Do you need to get a hotel room? You can do an Airbnb. Going to stay with friends. You're going to sleep in your car. Whatever that looks like, you need to think about that. And an emergency fund. You need to aim for about 3 to 6 months of expenses because once you own it, if something breaks, you fix it. So think about that. Pro tip, if you're buying a home is going to drain your savings to zero, then you're not ready. You want a cushion and not a lot of chaos. I mentioned already that debt to income ratio, the lender's litmus test, if you want to think of it. So DTI is how we'll refer to it. It equals monthly debt payments divided by your monthly gross income. That's how you come up with your DTI. So most lenders want it below about 43%, but 36 or lower is ideal. Include car loans, student loans, credit cards, personal loans, even child support in that as well. Pay down high interest debt first. It'll help your DTI and your credit score. Now, and you could also think about, Dave Ramsey, love or hate him, he has the snowball method, which is where you take whatever is your smallest amount. Think of a snowball rolling down a hill, and it's small at first, and then as it collects more snow, it gets bigger. Well, same thing. So pay down your lowest balance debt. And then take whatever your payments are. So once you pay that off, whatever the payments are you've been doing to that, then add that to the next one, the next lowest one, I guess I'd say, or the next highest one. And then pay off that. And then you take that amount that you've been paying there after it's paid off, and then you increase it here. So just something to think about. So financial readiness isn't just about getting approved. It's about staying stable after you move in. A home should be a blessing, not a burden. So take the time to prep your credit, build your savings, and understand your debt. And that way, when the right time comes, you're going to be ready to say yes with a lot of confidence. Okay, so we talked about financial readiness. Let's talk about emotional readiness. This is something that some people aren't usually talking about at that time. So are you buying a house because it's the right time for you, or because everyone else is doing it or telling you to? So I think there's some things you need to ask yourself. Do I feel stable in my job or my income? Am I ready to commit to a location for at least a few years? Does home ownership align with my lifestyle and long-term goals? Owning a home can be amazing, but it also equals responsibility. Repairs, maintenance, property taxes. It's not just a Pinterest board of cozy spaces. It's real life, and sometimes that can be difficult. So when we talk about emotional readiness, we're going to talk about something that doesn't show up on that mortgage application, your mindset. So are you buying just because, it's fun to get the little signboard that says just closed or said yes to the address, that kind of stuff, and all your friends are doing it, or because it's truly a great time for you? Job and income stability. So can you count on your paycheck? Buying a home is a long-term commitment, and lenders want to see at least 2 years of steady income. They also want you to have some job longevity. If you are in the same industry, but you've moved companies, have you stayed with the same company for a certain period of time? They want to make sure you're stable because they're giving you the loan. And if you default on it, then, there's the process that they have to then start doing. But beyond approval, ask yourself, do I feel secure in this job? And is my income predictable? If you're in a career transition, starting a business, or working gig to gig, renting might offer the flexibility while you're building that stability. So if your paycheck feels a little shaky, your mortgage will too. But buy when your income feels solid and not just approved. Location commitment. Are you ready to stay put? Real estate works best when you stay put for at least 2 years, but I would say 3 to 5 years. Selling too soon can mean losing money, especially after closing costs and compensation to agents. Ask yourself, do I love this area? Can I see myself here long term? Does it meet my needs? So if you're unsure about schools, commute, or lifestyle fit, maybe explore a little bit more before committing. All right. So lifestyle and long-term goals. Does home ownership fit your life? Do you crave flexibility, travel, and minimal responsibility? Well, in that case, renting might be better. Do you want to build equity, customize a space, and settle into a community? Then buying would be better. Buying could be perfect. Think about beyond the house. You see this house here, but you hate the neighborhood, or it's 3 hours away from your job. Think about that. So does this move support those bigger goals, career, family, financial freedom? And think about, a pro tip to think about. A home should support your lifestyle, not squeeze it. If it feels like a trap, it's not the right time. And the last thing for you to think about under emotional readiness is a reality check. It's not just, like I mentioned before, that crazy Pinterest board. Home ownership means repairs, maintenance, property taxes, HOAs, and sometimes unexpected headaches. So you're the landlord then, and you're also then your tenant. So when that leaky faucet happens, it's your problem. You can't call somebody. You can't call your landlord to have it fixed. You have to fix it. And you're going to want to fix it because a running toilet or a leaky faucet can really impact your water bill. So you don't want those things to just slide. You want to take care of them right away. If you're not ready to budget for upkeep or handle surprises, then renting might be that safer choice. Home ownership is beautiful, but it's not always very glamorous. So be ready for the real life stuff that happens behind that front door. So emotional readiness isn't just about age or income, it's about alignment. When your lifestyle goals and mindset all kind of point towards home ownership, that's when you're truly ready. And if you're not there yet, that's okay. Renting isn't failing. It's just choosing what fits for you right now. Okay, and the last thing that I want to talk about in my buyer readiness 101 is renting versus buying. We've talked already a little bit about renting. So what's right for you? So let's clear something up. Renting isn't throwing money away, and buying isn't always the smartest move. So the real question is what fits your life right now? So let's do a little pros and cons with renting versus buying. So renting, a pro. So renting pros, excuse me. Flexibility first. So pro, mobility. You can move for a job, a relationship, or a lifestyle change without selling a home. Lower upfront costs. There's no down payment, no closing costs, just your first month and last month's rent and a deposit. No maintenance headaches. If the AC breaks or if the roof leaks, it's not your problem. Predictable expenses. Rent is fixed for the lease term. So there's no surprise repairs or property taxes or things that pop up. So what's a con of renting? Well, you have no equity. Your monthly payment builds your landlord's wealth and not yours. Your limited control. You might face rent hikes, restrictions on pets, or limits on customization in the home. Like, can you paint? Can you not paint? You certainly can't probably take down a wall. So what does that look like? Less stability. You could be asked to move if the property sells or if the lease isn't renewed. So renting gives you freedom, but not ownership. So it's perfect when your life is still in motion. So buying. What are some pros with buying? Obviously, I mentioned before, equity. So you have equity growth there. Every mortgage payment builds ownership and long-term wealth. Stability. You control your space, your payments, especially with a fixed rate loan, and your future. Tax benefits. Mortgage interest, property taxes may be deductible. Customization. Paint the walls. Build a garden, renovate. It's all yours, so you can do with it as you wish. Cons. So what are some cons of owning a property? Upfront costs, down payment, closing costs, inspections, moving expenses, all up pretty fast. Responsibility. You're on the hook for the repairs, the maintenance, and the property taxes. Less flexibility. Selling takes time, and market conditions matter. So, if you bought a house in the frenzy of 2021, selling in 2025 isn't the same. Risk. If home values drop or your income changes, you're still tied to that mortgage. So buying builds wealth, but it also builds responsibility. And it's perfect when you're ready to stay and invest. So you need to decide, how to decide if it's what's right for you is ask yourself, do I plan to stay in this area for at least 3 to 5 years? Is my income stable and predictable? Do I want control over my space and long-term financial growth? Am I ready to handle repairs, taxes, and the unexpected? If you answered yes to most of these, then buying might be the next step. If not, renting gives you that breathing room while you plan your next move. Buying a home is exciting, but it is also a very big decision. Take the time to check in with your finances, your goals, and your gut. And if you're not sure where to start, I'm here to help. I'm here to have that conversation. So drop your questions in the comments below, hit subscribe for more buyer tips, and let's make your next move a smart one. Thank you so much for watching, and I'll see you on the next video.